Today, I'm going to tell you guys why I love LEAPS. LEAPS stands for Long-Term Equity Anticipation Securities. The P comes from anticipation. It's weird, I know, don't ask me why. So LEAPS is a form of option strategy on the stock market. All right, now options are derivatives of stocks. So if you remember back from calculus derivatives, you'll be able to get a good understanding of options. So today I'm going to use the example with Palantir, which is a data/AI company. All right. So currently the share price of Palantir is trading at $24.50 per share. All right. Now, if we went to go out and buy Palantir stock, we'd have to pay this price. And options, you have to buy options in 100 share increments. All right. So you're always controlling 100 shares per one contract. So, for example, if we bought 100 shares of Palantir, like straight equity, we'd have to pay $2,450 to control the 100 shares. And that's excluding the commission fee with your broker. All right. Now, if we went out and we did a LEAPS strategy options, we'd pick something with a high delta. I'll get into that in a bit. At a $15 strike price, so it's what's known as deep in the money because the strike price has already been surpassed. Now, the strike price lets the trade or like the options contract be executable. All right. So, because the strike price has already been surpassed, this LEAPS option has intrinsic value, and we have an executable trade already if we wanted to. All right, so that's why I put up here strike price of $15. Now we also have an expiry date. On options, you're gonna have expiry dates. And with a long term, that means we want something 5 months or more out. Here we have about, I think, 9 months or just under a year. All right. Now, if we went to buy 100 shares or control 100 shares using options and something with deep in the money, it would cost us $10.20 per share. So multiply that by 100, and it's going to cost us $1,020. So you can see that we've significantly reduced the amount of capital we needed to control 100 shares. We've cut it down over half, over 50%, all right? And we have a long time for our strategy or for our price target to be hit. We have to wait till July 17th, 2022. Now, what's the benefits of LEAPS? Well, if you want to get ahead and expand your portfolio quickly, you can take on margin, but with margin comes with great risk because you're using the bank's money, you're using a loan, and you have the possibility of being margin called. Now, if you get margin called, you got to sell. You either have to come up with new capital or sell those stocks at a loss. And you don't want to do that. You want to wait until the stocks become profitable for you to sell. So with LEAPS, you don't need margin. However, you are leveraging up. All right. And the amount of capital you can lose is the money you put in. So you have downside protection if the stock moves down. And you also have a long time horizon for the stock to play out in your favor. And that's why I like LEAPS more than margin, because you can leverage up, have downside protection, and not get margin called. All right. Now, how do we come up with $10.20 that we have to pay? Well, if we look at the stock right now, it's $24.50 per share. So we're going to take that minus the strike price, which is $15. And that's going to give us a $9.50. All right. This $9.50 is what's known as intrinsic value. this is our intrinsic value. Because if we could just go to the market and buy a call option deep in the money for $15 and then flip it for $24.50 and make that spread, then that wouldn't be an efficient market. So we got to pay for that intrinsic value. And that's this number right here, $9.50. All right. Now, we're paying, let me switch the colors here. We're paying $10.20 to control the 100 shares. So, this 70 cents extra, whoops, let me go back to red. This 70 cents extra, I believe it is, off the top of my head, is what's known as extrinsic value. All right. We're paying for the right to control 100 shares. So somebody is selling us this contract, and we're giving them the premium. This premium has delta in it, and delta tells us how much our shares are going to rise or fall for every $1 increment that the stock moves. So if the stock moves $1, if this is a 90 delta, 0.9, that means our stocks are going to move 90 cents for every $1 Palantir stock moves. Okay? That's some of the fundamentals. Now you're going to have theta as well. Theta is time decay. We're paying for time in this premium. It's almost as if you're leasing a car. That's kind of what it is like. All right? Because the closer you get to the expiry date, the more sure you know where the price is going to fall. All right? So that's how you come up with the premium of the call options. That's the gist of it, okay? And that is one of the fundamental reasons why I love leaps. You can expand your portfolio by a lot by leveraging up and having downside protection. And if you have a 0.9 delta, your stock or your options contract is acting like 90% of the underlying stock. So you might as well just own the leaps instead of owning the actual stock because you can leverage up. This would be really advantageous in a TFSA. Now, the downside, if you're not in a TFSA, is that it would create taxable events. If you just have it in a non-registered account, if you're selling leaps and they expire in 1 year, and instead of holding for the stock for 5 years, you'll create taxable events more often. But you might be offsetting that with the capital that is appreciating in value. So that's some of the reasons why I love leaps. Now we can go to the options calculator as well, and we can see Palantir. All right, and in here you're gonna be able to see the time decay. We're gonna go June 17th, $15 strike price. So if we buy it where the stock price is today at, what is it, $24.50. Let's do $24.75. If the stock is stagnant for this whole, let's call it 1 year, we're gonna lose almost 7% due to time decay. Okay. But we're gonna have a long period for this to play out. On the downside, you're gonna lose more money quicker because it's acting as if you owned 100 shares of Palantir stock. And if the stock rises, for some reason there's this ad, it's out of the way. So if the stock rises 20% almost here, we're going to get a 38% to 40% increase in our value. We're going to be double of what the stock would move. And this is going to help you create wealth quicker if you create the right, if you pick the right stocks, right? And that's a different topic. So guys, thank you so much for watching. Hope you learned a little bit here. And yeah,